Account Receivable Loans, how to get a loan against accounts receivables? Call 888-653-0124 today or click the link in the description to learn more. Minimum 3 months in business and $5,000 per month in sales. Account receivable loans are an excellent way to get cash quickly. They are also known as factoring, accounts receivable financing, and invoice finance. An account receivable loan is a short-term loan where the lender provides cash based on the value of outstanding invoices. The borrower pays interest on the amount borrowed, and the lender collects the invoices. If you want to learn more about account receivable loans, read on. Borrowing against accounts receivable. If you have accounts receivable, you can borrow against them by taking out a loan or a line of credit. This means you can use the money you owe to other companies to pay off your accounts receivable. Business owners count on business growth and profitability to stay afloat financially. However, if they don't make enough sales, their income will be insufficient for paying bills. In this case, these entrepreneurs must find ways to increase revenue. One method is through borrowing against accounts receivable. Factoring, what is it and why should you use it? The term accounts receivable refers to any unpaid bill owed to a business. Customers who purchase products from a store, restaurant, hotel, etc., sign contracts agreeing to pay for those items at a later date. The following information will help you understand how this works. 1. In exchange for getting paid upfront for those invoices, the business gives the factor all or part of their outstanding invoices. 2. If the business doesn't collect on any of these invoices, we can still collect them when it collects payment from the customers. 3. Factors usually charge interest on the unpaid balance. However, if there's enough credit risk involved with the business, factors may agree not to charge interest at all. 4. When the factor receives payments from the customers, he sends them directly to the business. Account receivable backed loan. A loan backed by accounts receivable is a secured loan where the lender takes ownership of the customer's outstanding invoices. This means that if the borrower defaults, the lender can seize the customer's assets to repay the loan. This type of business loan has become popular because many people do not like dealing with banks. Banks often require collateral such as real estate or personal property before granting a loan. These types of properties take months to sell, so most small businesses cannot wait that long. In addition, bank loans carry higher rates than non-bank lenders. For example, a bank might offer 6%, while a private investor could provide 10%. Also, banks typically require large down payments, which makes starting up a new business difficult. Non-banks, however, are willing to lend without collateral. As a result, borrowers must compete for funding. Since competition exists among investors, terms vary significantly between different sources. Our financing companies. Our financing companies are companies that provide financing for many projects for businesses. The business of accounts receivable finance involves buying invoices from clients and then collecting the amounts due. Our finance companies purchase invoices from various industries, including manufacturing, construction, retailing, wholesale trade, transportation, healthcare services, professional services, education, etc. They then attempt to recover the total value of each invoice sold. Once recovered, they remit funds to the client. Access to cash flow is critical to a successful operation. To access cash quickly, your company purchases invoices from the client before collection. They then hold on to the invoices until the debtors have made good on their obligations. At that time, the receivable companies release the invoices back to the debtor. Essentially, the difference between the original investment and return represents the initial investment plus the profit. An essential aspect of this model is that it provides immediate liquidity to the client. Clients need cash fast, and our finance company makes sure that happens. Cash reserves and additional cash flow allow the client to continue operating during periods when sales are slow. It also helps the client avoid bankruptcy since it does not have to rely on other creditors. The essential advantage of using a receivable financing company is that you get paid faster. You don't have to wait around for your paychecks to clear the bank. Instead, you get paid right away in the form of cash. That way, you can use the money to buy inventory, hire employees, etc. Business loans on accounts receivable. This type of business loan is ideal for companies with good credit ratings and a steady flow of incoming revenue. Cash flow shortages cause problems for all kinds of businesses, but especially those involved in seasonal activities. When demand drops off at the end of the year, these businesses may find themselves unable to meet payroll or even cover basic expenses. A business loan based upon future income is called a revolving line of credit. There is no set term. Instead, the borrower receives periodic advances according to his needs. If he wants more money, he draws on the available balance. He will be required to repay only interest charges and any outstanding principal owed. An influx of cash can help a struggling business stay afloat through lean times. Business owners often turn to banks for short-term funding because banks offer different rates than most alternative lenders. However, if a business owner has a poor credit history, banks might require collateral such as real estate holdings or equipment before granting him a loan. However, if a business owner has excellent credit, he should consider applying for a small business loan. Commercial lending institutions usually offer these types of loans as SBA and local banks. Small business loans come in two varieties, secured and unsecured. Secured loans involve some assets serving as security for repayment. Loan against accounts receivable. Cash flow gains from an accounts receivables financing company are typically higher than those gained from a bank. Banks charge high fees and make up much of their profits by charging borrowers late payment penalties. Many customers do not want to deal with the hassle of dealing directly with the bank, so they choose to work with a factor. Factors provide better service and lower costs. Factors generally take less risk than banks because they purchase many of their assets. Also, factors tend to keep overhead low because they operate out of one location and employ fewer people. Finally, factors can negotiate favorable terms with clients because they already know them well. As a result, elements enjoy greater flexibility than banks. A business credit card is another option for obtaining quick access to funds. Most cards allow users to draw down balances without having to put up collateral. They also enable businesses to build long-lasting relationships with potential new customers. The downside is that they carry hefty annual fees. In addition, it isn't easy to obtain approval when starting. Accounts receivable loan rates. If you are looking for an alternative to payday loans, then accounts receivable financing may be right for you. An accounts receivables financing company rates depend on many different factors. Some include your current debt load, how quickly you need the money, and whether you have other options. The first step in getting approved for an accounts receivable finance program is determining what rate you qualify for. You'll get this information after submitting your application. Once you've been accepted into the program, you'll start receiving payments every month. Your monthly payments will vary depending on your specific situation. For example, you could earn between 10% and 20%. Depending on your circumstances, you may be eligible for additional perks, including discounts on insurance premiums and accessible legal services. Ask yourself several questions to determine which accounts receivable financing programs are best suited for your particular needs.